Bismillah ar-Rahman ar-Rahim. Today I'm going to talk about market efficiency. But in the first, I will revise the meaning of financial planning, because maybe some students get confused from the financial planning concept. What exactly? Because I'm not talking in this chapter about the financial planning related to the companies. I'm talking about the financial planning to the individual or investors. So there is a big difference between the financial planning of the companies, corporations, or the individual. But why the individuals has to do financial planning? To determine their portfolio. Okay? To determine their portfolio. This is the important. And as we explained in the chapter 1, the portfolio is a combination of different assets to increase return and minimize risk. In order to combine this portfolio, we need to have a financial planning for individual. So the first step in doing this is setting goals. It's very important. Then asset allocation. After that, consider the taxation, how the tax influence on the financial planning or the investor decision, and finally forming the portfolio. The portfolio in here is not the end of the individuals, which is it's like a mean for the individual to satisfy their objective. So this is the most important of the portfolio. For setting goals, as I explained in the previous meeting, people has different goals. Okay, they have different priorities in their life. You could be one of these people looking for investment to emergencies, to purchase homes or cars, for retirement, for charity things, or either to speculate or gambling. In the goal, when we are setting the goals, we should be careful to understand the financial life cycle. It's very important. We have 3 stages in your life based on the financial cycle. The first stage is the accumulation period. The second is the preservation, and the final is the use of investment. If just give some criteria to the each stage, in the first stage, we have the cash in. Yes, is less than the cash out. Why? Because we have more obligations when we are very young. Let's see, in our 20s, education, tuition fees. We need to purchase house or to rent a house, traveling, and etc. This is why the cash out is greater than the cash in, or in other words, the expenses is greater than the revenues. There is a heavily demand on the cash in your early stages. And the second one, which is the preservation, people be more relaxed. When you are in your mid-30s, you secured your house, you get married, you have your own car, other things in your life, and in this case, the cash in is greater than the cash out. In this time, it's possible to save your money and then to invest. Just link this idea with the chapter 1. We said the saving is a channel to investment. It's help you to invest. If people do investments in this time, so they invest for the future. In this, it means saving the purchasing power for future use. Okay? When the future coming, which is coming in the third stage, you are no longer have the capability or the capacity to generate cash, because you are in your 60, 60 years old, and you don't have, you retired, or if you are a businessman, you about to finish your work. So in this period of time, you can use up what you invest or what you invested in the second period of time or in the second stage. But if you don't invest in stage 2, you will be broken in the stage 3. So be careful. In the second stage is the most important stage because the investment is in the second stage, and in the third stage you are using up the depletion of the investments because you are using the investments. It means you are consumed the investments. Okay, you are not invested, or you are not invest in this time. You only using what you invest. This is the main difference. And in this time, the cash out is greater than the cash in. This is in case that you don't have investment. But if you investment, the cash in is approximately equal the cash out. The cash in is approximately equal the cash out. My little question is in here. In the second stage, from where the cash in coming? The cash in? Yes, from your salary, from your financial resources. Okay, you may have your business, you have your job. But in the third stage, from the saving, from your investment. Okay, so this is the main difference between the 3 stages. Any question related to these stages?
No.
Okay. In addition to this, people should match their objective or their goals with their financial resources and obligations. You have financial resources and financial obligations. Okay? So the financial resources includes many items. You could have you could have real estate. You may have cash from your family, for instance. You may have assets. Okay? So in order to estimate or to examine what you have in terms of financial resources, we should design your financial statements or balance sheets. Your balance sheets. We know the balance sheet is only designed for the corporate or for companies. But for the individual based, it's fine to have the balance sheets. The balance sheet reflects your financial resources, okay, and your obligations. In other words, we classified them into current assets, fixed assets, okay, and you classified fixed asset into tangible asset and intangible asset. Okay, and your the liabilities, you can talk about current liabilities, long-term liabilities, and equity. The brokerage companies, they design these things for you because majority of individuals, they don't have skills on how to estimate the balance sheets. When you are opening an account with the brokerage services and with the dealer, in order to know your objective, the first step, they try to estimate the balance sheets. In addition to the balance sheet, you should, or the investment company, they should design the cash budget. The cash budget is the cash in and the cash out. Okay, the saving and disbursement, which is very important. Okay, if you are plus, it means you can invest. If you are in minus, you need to develop or to improve this situation. And these two items or two statements help the individuals and the investors to decide how much to invest. Okay, and these two statements should be linked with the stages. Okay, so in the early stage, the first stage, the cash out is greater than the cash in. In other words, this is help you to decide in which assets you invest your money. They may done by constructing. We explained this: the balance sheet, what is owned and what you owed, the cash budget, cash receipts, and cash disbursement. Okay. So this is very important to the investors. The second step is the asset allocation. Asset allocation is what is the portion of money invested in each asset classes. Okay. So in the asset classes, as I explained before, you have debts, you have equity. Okay. In the equity classes, you have different equity families, and in the debts, the same things. You can either talk about short term or long term. You can either talk about the risky asset or less risky assets. Okay, and you should think in determining in the asset allocation, what is your investment policy, the market timing, and asset selection. Okay. The main difference between assets allocation and asset selection is a process detailed the asset allocation. For instance, if you decide to invest in equity, you have different types of equity, or you have different firms. You want to invest in technology? Okay, in technology you have different stocks. You want to invest in the foods industries? You have different firms. Pharmaceutical industries, in let's see, furnitures. You have different stocks. You either invest in technology or in furniture, or development companies, or you may invest in companies in financial institutions, or you may invest in mutual funds or in portfolios. It depends then. So this selection is a detailed process of select a particular assets among the big family of assets, like the equity. If you talk about debts, you have different bonds. You talk about zero bonds. You talk about corporation bonds, corporate bonds. You talk about junk bond. You have different types of bonds. As I said, the third step of the financial planning process, if you go back, and just to remind you, we cover the setting of goals and asset allocation and consider the tax. I'm not going in details about the taxation, just to give you a brief about the importance of taxation relative to the investments. In here we will focus on the capital gains and capital losses, because it has a tax shield comparing with the current revenues. Okay. So in the federal personal income tax, generally speaking, in terms of stocks, you have dividends. Dividends pay higher tax than the capital gains. There is a progressive in terms of developing the Tax Act, because to make it fair between the different households. And as you know, the importance of the tax brackets, each person has his or her income level, and the income level is connected with a particular tax bracket. For instance, people have $50,000, they will pay 30%, for instance, tax. People greater than $50,000 till 100, for instance, they will pay 35%. People with 100 plus to 200 pay 40%, and so on. This is called the tax bracket. The more you have, the more income you have, the more tax you pay for the. But still, people with the higher income, they have techniques to avoid paying high tax or higher tax. So the new law reduces tax rates over time because they encourage people to save more and to invest. This is the implication on investment, in particular for the capital gains or for the capital taxation, because the capital has a direct influence on the investment. So if the government's asking people to pay high tax on the capital, it means they reduces the money available to investment. Okay? But the government try to increase the tax rate on the current revenues. It means indirectly encouraging people to save for the future payrolls. And I revise in the morning, I revise the recent act in the United States, and I observed that the majority of these regulations is to protect people or to encourage people to invest in the future. Okay, by reducing the amount of money paid to the government, okay, and this saved money from the tax is channeled to the investment. Okay, so this is the idea of the tax. So a tax shelter is avoid. It means to avoid taxes. I'm not saying here is the illegal avoid tax, but is like legalize things to avoid tax. Try to avoid tax. For instance, stocks paid dividends. Okay, you pay 30%, for instance, on the dividends. But if the company decide not to pay out dividends, it means there is no tax. And this dividends, this dividends reflect itself in the price, which increase the price of the company. Okay? So in this case, if the company has two options to pay out in terms of dividends or to retain earnings, this is the another option. If they pay out, they will pay higher tax. If they retain earnings, they may not pay tax. It means make the retained earnings available investment to the company, encouraging companies to do investments. And if the company retain earnings, it means indirectly they're encouraging them to expand, to do expansion. Okay? So when they are doing expansion, the price will go up. Okay? So in this case, when the price go up, the investors may make a capital gains. And the capital gains have or has less tax. So indirectly the companies, the government saying to the companies, you either pay no tax, zero tax, avoid tax, or you can reduce the tax if you are saving your money. Okay, it's like encouraging people to save their money or to invest. This is the idea of how government using a tax shelter as a tool to encourage people to invest.
طب يا دكتور لو استثمروا عملوها retained earning واستثمروا خسروا بيكون التاكس.
Yes, this is a good question. If they lose their money, the capital loss is offset the capital gains. Okay, the capital loss offsets the capital gains. We will talk about this. If the capital loss not offset the capital gains, it means the company will trouble. What it means the tax itself covers the loss. Okay? This is indirectly. We don't have that good awareness about the taxation because the majority of people not paying tax because of the current situation in Palestine, and this is why people they don't care about the tax rate. Okay, and the majority of business here they don't pay tax, but in the United States and in other European countries, including UK, they do care about tax. Deferred taxes. You can defer tax, for instance, from this year to the second year. But how they do this? By encouraging, let's say, for instance, if you have your salary, okay, and you should pay 30% of your salary to the tax. But if you invest a portion of your salary in the pension funds, you are free of tax, or this investment is deductible from tax. It means, sorry, in pension funds. For instance, if you said, okay, my salary is $1,000, I pay $300 to the government, okay, and 150, 300 to government. If you decide, if you are smart, if you decide, okay, I will invest, I will take from my salary $300 and invest in pension funds. Okay, you know what it means, pension funds. Okay, صندوق تقاعد. In the pension funds. So according to the regulations, the recent regulations in the United States, they said, okay, if you do this, it means it's tax deductible. It means that you can pay this from the tax that you pay to the government. So instead of paying this $300 to the government, you pay it to the investment. And in this way, you are deferring the tax. When you pay the tax, when you withdraw your money, when you are in your 60 years old, you pay tax in that time. You are not paying tax today. And this is the meaning of deferred taxes. Okay? It means giving you more channel, more flat platforms to invest. Not just paying all of your money to the governments. It's just the government try to encouraging you, to motivate you, to have different channels, because at the end of the day, the government will take their money, but in different ways. If you invest in companies, so the companies they have revenues, the government will tax the government, tax the revenues. So it's indirectly taking the tax from your investment in the company. Okay? So, and this is why there's a huge volume of investment in these countries. Not just taking, the government is just only need your tax. There is a smart ways from the government in which they can take the tax from you. And taking the tax from you is not directly from you, is from the company that you invest. Yeah. And the company has a stronger power than you, because they have more revenues and they can pay from the revenues. Okay? Yeah. So it's, and we know avoid taxes, how you can avoid tax, how reduces the tax and defers. The majority of the recent technology in the tax may pay attention for these things, particularly in the period of recession. Any question? The examples of tax shelter, we have tax exempt bonds, capital gains, as I explained in the capital gains, is considered as a tax shelter. For instance, if you buy the house to sell it in a short period of time, which is called short capital gains, you are paying higher tax. But if you decide to sell the house after 2-3 years, it means you should pay less tax. So why the government do this? Again, in the capital gains, we should differ between two different capital gains: the short capital gains and the long capital gains. The shorter capital gains paying higher tax than the longer capital gains. You know why the companies do, the governments do this? And this is why it's called tax shelter.
If the short capital gains pay less tax,
No,
the people...
sorry, the short capital gains pay higher.
Yes, I'm saying if.
Yes.
Yes. That will mean people will keep buying, selling and buying in short periods too.
What is the implication on decision and on the investment?
That will discourage them to invest.
Okay, which you prefer to, which has direct, or let's say a solid implications on the business, to invest in the short run or to invest in the long run? In long run. So it means the government is motivating people to invest in the long run, and because they invest in the long run, it means the government make them for more enjoyment. It means more enjoyment, less tax. Okay? So this is why it's important. We have tax-deferred pension plans. As I explained, tax-deferred, you only pay tax when you withdraw your money when you are in your 60s or your 70s. Tax-deferred annuities, the same things. You can defer it means you can take the tax and you invest in the IBRs or in the QS accounts. I will introduce you about some investment instruments that they can apply. Life insurance, you know life insurance.
Yeah.
Life insurance is a tool of investment. You know this? Life insurance is a tool of investment. Some people, they sell this in a particular time in the future because you are paying amounts every month or every year. Let's say 50% of your salary. It means you are saving. In a particular period of time, let's say when you are in your 50 and decided to sell the life insurance, it has a price. You can sell it. Okay? So this is, I'm not here talking about the insurance companies or the details of how to invest in insurance, but it is a good channel to invest. Okay? And you can make good money in the life insurance investments. Employee stock option plans. Employee stock option plans, this facility is given by a particular company to the employees to buy stocks if they have a considerable achievement in their business. For instance, if the company is saying to you, okay, if you make 20% return on investment, okay, or if you increase the sales by 15%, if you do this, we give you opportunity or option to buy our stock, okay, at this price, $50. Suppose we are talking about Google. The price is $439 or $38, and the company is saying to you, if you increase the sales by 15%, we give you option to buy the stock by $50. But the current price is $438. So it is worth to you. The beauty of this, the $50 that you paid is tax deductible. Okay? Because it means it's a channel to invest. You see how the investment is important in our life. Okay? See? Yes, we have tax-exempt bonds, capital gains, tax deferreds. We explained these. Capital gains, I explained the capital gains, are either short-term or long-term. As I explained, you buy the house today and you sell it after 3 months. you pay a particular tax, for instance, 15%. See the difference, 15%. But if you sell it after 2-3 years, you pay less than the 15%. Okay, so this is the idea or the difference between the short-term or long-term capital gains. Short-term is a year or less. We already know this. Short-term capital gains tax rate, the investor's marginal tax rate. It's related to the investor's brackets. Long-term is greater than a year. We know this. Long-term capital gains tax 10% or 20%. If this is 10%, for instance, for the capital gains, for the short gains could be 20. If this is 20 in the capital gains, the short one could be 40 or 30%. Just to make the difference between the short term and the capital gains. The short term are only taxed once realized. Are only taxed one time. But for the current dividends, for instance, or the current yield, it taxed every time. For instance, your salary is taxed every month. But for the capital gains, is taxed one time. Your pension funds, your tax is only one time. May hold and assist indefinitely and avoid capital gain taxes if you use long term. Also, as I explained, capital loss is offset from the capital gains. Offset capital gains. For instance, if you lost $3,000, which is subject to tax, for instance, this loss is offset from the capital gains for the next year. The capital gains in the next year is $9,000 times the tax, so this one is deductible from tax. And if the capital loss is exceed the capital gains, it could be deferred for the next years, the second year, the third year, and so on. It means they want to make the investor more relaxed when they have loss or when they have capital loss. Okay, there's a lot of things to read around these things. Particularly if we have accounting student here, no? Yes, accountant should know about tax regulations. You have these things in our regulations in Palestine.
No.
So it.
Palestine, as we took in the taxes course, that the capital loss does not offset the capital gains of the next year. Because
So?
I think that if you lose money or you lose a particular project, you do not pay taxes on
So-
this project.
So which one is helping investors? The American or the federal regulations or the Palestinian one?
If every country has its particular setting and difference.
Okay. Okay. Any question? Okay. The order of offsetting gains: first, short-term loses offset short-term gains, short by short. Second, long-term loses offset long-term. This is okay. We should define what is short-term loses and short-term gains. Then this offset each other, or in the long-term loses offset long-term gains. And it could be the long-term loses offset the long-term loses offset the short one. Third, net short-term loses. You know what it means? Net short-term loses. Net short-term loses is the short-term loses minus the short capital gains. So they take the net. This is called net short-term loses. Short-term loses minus short-term capital gains. If this is in minus, it means we have net short-term loses. So we have 10 net short-term losses. And this, if we have this, it means we have long-term gains. We can offset the net short-term losses from the long-term gains. And if the long-term gains is less than the net short losses, we can defer this for the next year. Net long-term losses offset short-term gains. Okay, and net long-term losses. In this case, the long-term losses minus long-term capital gains, we end up with a net long, and it could be offset from the short-term gains. Don't get confused from these things. I may not ask you about the detailed, just to have the general concept. Okay? So don't worry about this. The deferred pension plans. Deferred pension plans also is a channel to defer the tax. Deductible traditional individual retirement. This is what I said. The IRA. The IRA, individual retirement account. In this individual retirement account, you took a portion of your salary and you invest in the future. Contribution limit $3,000 annually of earned income. You contribute by $3,000. Okay, and we have two types, I think, in this. We have defined benefit pension, and we have defined contribution plan. In defined benefit pension, the employees pay nothing. The company or the employer pay everything. But in the contribution system, the employees pay for the pension funds. If not covered by a pension plan, contributions are deductible from the taxable income. Okay. This is the QS account is similar to IRA. This one, QS. Again, don't get confused. Sorry? Okay, just to have an idea of how people... The QF account for the self-employed. Self-employed, generally speaking, if you are as an employee, so you have two options. You either the employer pay for your pension plan, or you contribute from your salary. But if you are self-employed, you don't have employer. Yes, the American system gives you opportunity to save from your money in the pension plans, and this is tax deductible. It means it's helping you to do this. So contribute 25% of income, or 35,000, whichever is smaller, and this amount of money is tax deductible. It means, in other words, to give a channel to the self-employed people. It's not only because it is unfair that to avoid tax or to have tax shelter by the employees of the employed people, and we don't have tax shelter for the self-employed people. Effective contribution limit is 20%. Contribution deductible from taxable income. So your contribution is deductible from your tax income, which is, it's fine. If you do this, it means you are not paying to the government, you are paying to yourself for the future purposes. Asset in the account selected by the individual. The beauty of this, of the QS account, is give you opportunity to invest by your own, but through investment company or brokerage company. Okay, you tell them, okay, this amount of money, 20% of my salary or whatever, is a channel to this particular investment, and you declare this. Okay, and in this case, if the tax, let's see, the people in charge in supervising tax, if they agree on this, you are subject of tax deductible. Okay, so it's not just okay to say, oh, we deduct or we invest in this. You should show them and declare to them that I'm doing this. Okay, and if you sell this, withdrawals, only the withdrawal is taxable. You can keep it for long life, and you don't need to pay tax. Only when you withdraw, it means when you liquidate the investment, it is a subject of tax. And this subject of tax is considered as a capital gains, and you pay less tax. In other way, okay, it's a channel to you to invest. And they have different plans. Plan offered by employer, as I explained, in the defined benefits plan. And the second one is the contribution benefit plan. Okay? We will talk about the market efficiency. Any question? Wallah? Okay. You can read it. I will go to the efficient markets. Okay. The efficient markets. You have a break for 1 minute. Just only for 1 minute. Sorry? بنات في عندنا we have a question. خلينا نسأل سؤال. تفضل. No. And definitely no. Why? Because we have individuals with different goals. Okay? Some people, they want to avoid tax. Others, no. Because if we have a lady in her 60 years old, okay? So what is the idea of avoiding tax if she has no cash? So she's in her retired age, okay? So in this case, she's looking for a particular stocks paying dividends. It doesn't matter of the tax. Okay? So this is the idea, because we have different goals, okay? People in their early stages of life, they like to invest. So the tax regulations help them to save. But we have people in their retirement age. In this case, we don't have space to invest, but we have a space to spend. We need more cash. So this is the idea. It depends on which stage you are in. What is your obligations? Okay? In the second stage, particularly in the second stage, you don't need more cash, because you are you secure in life. You have your house, you have your car, you get educated, you have everything. So the thing is here is to invest. In this time, you are looking how to avoid tax, because you need to invest for when you are in your 60s. Okay? If you talk about the child, they need this, because they need investments. Their parents, they save money for them, set the money in a particular mutual funds or in a particular saving accounts, and this saving is tax deductible if not withdrawn. Yes, because if it's withdrawn, it means is subject of tax. Okay, so it depends. Go back to the goals, and from the goals you can decide which appropriate investment style is fit your size. Okay, now the efficient market hypothesis. Any idea about the efficient market hypothesis? No? Yes? You've experienced this before? Huh? You've experienced this before?
Yes.
Okay, what it means, efficient market hypothesis? This.
The efficiency of market depends on the type of information that they use.
Okay.
And the liability. Weak efficient market, they depend just on the past past information.
The historical prices. Okay.
The semi-strong, they depend on current.
Okay, let's ask very little question. Is it important to have efficient market? Yes, why? My little question is
Cost of investment.
is the difference between efficient markets and not or inefficient markets. Is important to have efficient markets? If yes, why?
Because the spread in the efficient market is little. Because
Sorry?
the efficient market cost here
The cost, yes. One of the criteria, the cost of transactions
is
is
little.
okay. Okay. So when it is the cost of transaction is,
And efficient market cost is little.
let's go back to the question. Is important to have less cost transaction? Yes. Why?
To increase the return.
Okay.
Yes.
High profits. Okay.
Higher information will lead us to more investments or
The efficient markets, the importance of efficient markets, is exactly like in this class. I'm delivering the speech to the students. So students equally listening to me. Okay? So students are equally treated. But if the market is not efficient, if I'm not efficient, for instance, okay, 5 students, I talk to them, give them more explanations, so it means it's not equally. The importance of having efficient markets is to have normal return. This is the important. This is the importance of having efficient markets, having normal return. So people, either informed people or uninformed people, if they access the efficient markets, they get normal return. It's exactly like my example in the first meeting when I talk about fish.
yes.
But if the market is not efficient, okay, I took 5 students. I'm giving them, okay, this is 5 exams. Just train yourself on these exams. And the rest of the students, they don't know about these things. Then I will have inefficient results.
Yes.
I have bias
Yes.
results because some students they have extra information or private information about the exam. Others they don't have. So again, to have efficient markets, the information is equally distributed or disseminated to the people. And the idea of information is unpredictable. This is the importance of information, is unpredictable. If one predicts, for instance, one of the students took my exams, the previous exams, do it in the machine, it means to do analysis to my exams, and she or he generates a model exam, and it be typically or 80% of my previous exams. In this case, he or she can easily pass the exam. Okay, so she can predict. But in the efficient markets or the efficient exam, no one can predict because this is randomly. Even you are using your superior information, okay, and it's not replicated, it's not copied from the other exams. It has different ideas, it has different techniques, it's just examining different corner in your study plan. This is the efficiency of the financial market and the efficiency of your exams. Okay? Yes. So the efficient market hypothesis, which suggests that investors cannot expect to outperform the market consistently on a risk-adjusted basis. So, as we mentioned before, you cannot fish the big fish in the efficient markets. And if you do this one time, you cannot copy it again. Because the market is out smarter than you. Okay? The assumptions of efficient market hypothesis, there are a large number of competing participants in the securities markets. Large number, mutual funds, investment brokerage, dealers, governments, financial institutions, investment companies. All of these people are focusing on analyzing the information. And if they do this, they try to have similar judgments. It means this is the information. This is the database of a particular company. I give it to you. You do the analysis. The more you analyze, the more people invited to analyze the company, the more accurately the price. The less people invited to analyze or to contribute, it means the less efficient the markets or the less efficient the price. Okay? It means when you invite your friends, you be careful. Okay, you prepare a dish. But if you invite 5 people, oh, mom, please, 5 people, okay? Then if you invite 10, it means you are more careful to prepare the dish. Because if you have problems, the information is disseminated for the rest of the class. Yeah. Oh, see?
It will be a scandal.
Sorry?
It will be a scandal.
Yes. Oh, yeah. And you can observe this in your kitchen. If you have more guests, it means you are carefully everything on time. But if you have one, it's no problem. You can eat at any time. So the idea, the more people invited to the market, the more accurate the price, and vice versa. We will go back to the discussion of information is readily available and virtually costless to obtain. Information is available to all people and is costless. In chapter 2, we explain the cost of transactions, the bid-ask spread, and the commission. And the importance of this, we don't mean that we have zero cost. We mean the cost of the markets have less cost is more efficient. But we don't mean that zero cost. However, in the financial institutions, they are subject of less transaction cost because the huge of investments or the large volume of investments make the transaction cost is less than the individual investors. But still, the individual investors, they have a platform to invest in less cost assets, like the mutual funds, which is very important. So the efficiency of the market is not only related to the information, but the availability of the assets with the less cost transactions. The transaction costs are small, comparing with or relative to the other financial markets. And this leads us to talk about random walk. I will stop here, and in the next meeting we will finish chapter 3. So please read about the random walk and prepare yourself for chapter 4.
We will start the exam.
Your exam includes chapter 1, 2, 3, and 4. Okay?